Mm.
I'm waiting to see new participants. Now I can see the numbers rising.
Okay. There's a attendee number on the side.
Some people may be late. Let's wait for a few minutes for participants to log on.
Mm-hmm. I see Chen Enjiang's there.
You can see the numbers increasing.
Mm. I guess it's more or less there.
Now it's 9 o'clock, 9:02. So I guess we can start. All right. Let me start. Hello, everyone. Good morning and a good afternoon to our friends in Europe and good evening to our friends in Asia. Welcome to this inaugural webinar for the Global China Research Colloquium. This is the first of a series of events in the fall of 2021. These seminars invite experts to share their latest research related to China. My name's Yan Wang, a senior researcher with the Boston University's Global Development Policy Center. Our director, Professor Kevin Gallagher, could not attend and sent his apologies and asked me to moderate this session. It's my great pleasure to moderate. First, let me introduce about our Global China Initiative. The Global China Initiative GCI program studies the issues related to China's overseas development and economic activity and engagement, and discuss whether or not these activities foster a more inclusive and sustainable, environmentally sustainable development in the world economy. GCI is part of the Boston University Global Development Policy Center, a think tank that works to promote policy-oriented research to reach financial stability, human well-being, and environmental sustainability. Related to the last topic, Chinese President Xi Jinping announced yesterday that no more coal-fired power plant will be built, which is good news. Now, let me introduce our speaker, Dr. Ying Chen. Dr. Ying Chen is a former director at the Asian Development Bank, now a freelance consultant. Prior to his retirement, he was the director of public management, public sector management, financial sector, and the regional coordination division. And he and his colleagues implemented programs and projects in the areas of public finance, financial sector development, trade, and investment. Previously, Ying has also worked at the World Bank, where we had a lot of interactions. Ying holds a PhD in economics from Duke University and an undergraduate degree from Renmin University, China. A little bit the background, as you know, many emerging market and developing countries started to accumulate debt even before the pandemic. The COVID-19 has exacerbated the situation. A debt crisis is looming up large. World leaders are struggling and searching for new ideas on how to reduce the debt burden in an equitable and sustainable way. Dr. Chen will discuss how Brady-bond-like transactions can be considered for today's debt resolution. His paper is published today as GDP Center's working paper. A link will be given in the chat box below the screen, and you can click on the link. He argues that the general principle applied in the 1990s can also be valid and applied to today's moment. And there are several favorable factors, including the recent allocation of SDRs at the IMF and expanded lending and guaranteeing capacity in the World Bank and the IMF. He will also discuss the state contingent debt instrument, such as commodity-linked bonds. Now, a little bit about the logistics. I want to mention that this webinar is live streamed on YouTube. When you ask questions, please use the Q&A box located in your Zoom menu at the bottom of your screen to ask your question. Please also type in your name and affiliation. We will take questions after Ying's presentation. Now, without further ado, over to Dr. Ying Chen. The floor is yours. You have about 25 minutes.
Thank you, Dr. Wang Yan, for the good introduction. Let me share my screen first. Like Dr. Wang Yan mentioned earlier, the world is certainly facing many challenges. One of the challenges are certainly the debt crisis, particularly among least developed countries. This round of new debt crisis, certainly it's a lot of common features like in the past, but also has some new features. One such notable new features is the creditor side. Traditionally, the creditor tends to be coming from industrial nations like the United States, European countries, and Japan. But now, China become one of the major debt creditor country. China is certainly people heard about the Belt and Road Initiative, many of the go outside strategies. Some of these related to loans and credits provided to the partner countries. So many of these has resulted in some of the problem loans. So I guess the research is a good opportunity to look at during this debt crisis, what kind of old approaches can be used to today's new situation. So Brady Bonds is one of the proposal we are looking at. So let me go ahead. First, I will go with some of the challenges developing countries are facing. Then we're looking at the Brady Bonds, look like Brady-bond-like restructuring type. And we'll look at the variations. Some of the variations are state contingent debt instruments and also related to green finance. And then we will summarize looking at issues to consider. Some of the challenges, you can see many of the developing and emerging economies are facing debt crisis now. If you look at the statistics, the outstanding debt to China can be as high as 380 billion in 2019. This particular number may be exaggerated. However, the number amount is not small. If you look at the total money owed to China by the countries on the World Bank's debt service sustainable initiative list of 72 or 73 countries. China has about total of 62% of its debt dispersed in Africa. These all compose about 22% of these countries' public external debt. Currently, many of these countries are in a so-called sustaining phase for 1 year. So the debt servicing will presumably restart after 1 year to the end of 2021. So far, there are a lot of collective efforts by the international community to put together to resolve the debt crisis. So quite many research papers are looking at this already. These related to Brady Bond, look like restructuring plans, and then some variations putting into it. One notable suggestion is what was made by the International Monetary Fund to look at the state contingent debt instruments. There are also many researchers are looking at the opportunities to embark in green and climate finance initiatives in exchange for debt restructuring from developing countries. So many of these are very innovative ideas. Certainly the Brady Bond has been proven. Some other ideas are basically adding some variations to it. So let me go by one. Brady Bond, many of you probably heard. It was first initiated by the United States. The name is coming from the then the Secretary of Finance, Secretary of Treasury, Nicholas Brady. It was initially proposed to address the debt crisis in Latin American countries in early 1990s. A typical transaction structure, this is a very simplified, is such. You do have, for example, the blocks are basically the players, 5 different players. You do have people behind these blocks, including, for example, US Treasury, and also in international community trying to put the whole deal together. Essentially, it's a debt swapping program with the haircuts. So the face value of the debt is being reduced. In that country is in agreement with, for example, if you look at the lower left bottom, International Monetary Fund or the World Bank, they agree with the program with these international organizations to look at the reform policies, fiscal policies. In exchange, they will get new loans. And using these new loans, they will basically post collaterals in order to issue new bonds, new debts. The new debt is probably going to be in a lowered principal amount. And this new debt is going to be used to exchange of the outstanding loans. And the banks which originally holding debts will be agreeable to take the new loans, new bonds to them. The reason is that it will increase the collectability of those loans because the old loans is no longer being serviced. And for them to be able to take the new debts, they will need more comforts. So the comforts will be coming in the form of collaterals, posted in securities. For example, the debtor countries will use the loans from IMF or World Bank to buy US Treasury bonds and to be held in the separate accounts. And the same is also done by posting collaterals for interest payments. Eventually, when the creditors holding the new bonds, basically the bonds will have a generic name of Brady Bonds. They will be able to trade those bonds in the secondary markets so that they will eventually to offload those loans from the balance sheets of the bank. So basically, it's a very simple structure. It's the debt swapping with the credit enhancement and the haircuts. So modern dozens of countries they actually issue the Brady bonds. Some are actually outside of Latin America, for example, some European countries and some in Asia. General principles and technicalities of the Brady bonds are such that certainly will be a lot of coordinations among creditors. Hopefully, all the major creditors are included so that you don't have any holdouts. There will be basically having some element of debt relief in exchange for greater assurance of collectability. In sort of common terminology, people say is a haircuts. Normally, the level of haircut is in 30 to 40% of the principal amount. And then in order to make sure the debtor countries are basically putting themselves in a sustainable path, there were some linkages of the debt relief to economic policy reforms. And then as earlier, we see the transaction structure, there will be some mechanism to put into place in order to make the resulting the new bonds highly tradable. On the technicalities, we already said that a bond principal is collateralized and the rolling interests are guaranteed. Generally, countries issue two kinds of bonds based on the same principle. One is called fixed rate par bonds. Generally, the haircut is on the interest side. So the principle is basically keep the same as par. Or you can have discounted bonds where the principal has been reduced by 30 or 40%, but the interest is going to be market-based floating. Many of these bonds have a relatively longer tenor, which is about 25 to 30 years. So then you see many variations from the general principle. You do see different, structuring of the bonds. Some are actually uncollateralized, and some are with the shorter tenors, and some are capitalized interest into the principal. The role of IMF and the World Bank are very important because loans from them are usually in the form of policy loans. And usually the policy loans, many of us know that there will be some associated with the policy reforms and some commitment. The government will sign loan agreements committing for sometimes pretty harsh policy reforms. And that sometimes do invite criticisms to the IMF in particular. The experiences and case study, we actually look at the first case, which is Mexico. Mexico was the first to use the Brady bonds in total to restructure about $40 billion of distressed debts. Mexico basically, like I said earlier, issued the par bonds with the low and fixed interest rate. At that time, the interest rate overall environment is quite high. So 6.5 to 6.25 is already a heavily discounted interest rate. And also they issued the discount bond with the 35% haircuts from the principal and have a floating rate of LIBOR plus a little bit less than 100 basis points. All are having an original maturity of 30 years. And the rating is slightly below the investment grade, which is actually already quite an enhanced rating. Both actually have an interesting feature, which I will elaborate a little bit more later. It's called the oil price recapture clause. Basically, because Mexico is a major oil exporter, so the revenue can fluctuate based on oil price. So oil price is going up, Mexico will have presumably more income, so their capability of service the debt is higher. So because of that, the arrangement is made so that they can give more debt service during the good times. Actually, Mexico has a good success using Brady bonds to embark in economic reform and fiscal prudency. There were reforms introduced by looking at the exchange rate, inflation targeting, labor markets, and so on and so forth. And Mexico actually has improved their macroeconomic stability. So in the 2003, the economy is such in good shape. So Mexico decided to brought back its Brady bonds in 2003. The conditions now is on the international market is much better partly because of Brady Bonds. So debt markets for developing countries are well developed. So if countries are issuing new bonds, the market will probably likely to embrace it better. So the sovereign bonds become a preferred financing instruments. And now you do have more roles to play by the official sector rather than non-official as in the past. There are also some good news, encouraging more resources are made available to support the distressed restructuring. Partly is coming from the recently approved new SDR, the special drawing rights of the IMF allocation of $650 billion. Which made available to all the countries, but certainly to least developed countries, they are probably going to look at $20-some billion additional capital which can be used. And then certainly the IMF, the World Bank, and other regional development finance institutions also have special trust funds and new allocation funds to be used for post-pandemic support. And part of these can be used for that restructuring. Presumably, there will be more streamlined, transparent process on the analytical parts. IMF, they have a long so-called overdue debt sustainability analysis framework. That framework has been hearing basically suggestions from many partners. They are coming to a major revision. There are new guidelines for market access countries, so there will be more to come to reflecting the reality of the markets. So making IMF's policy package more realistic, implementable, and also more conducive for countries' long-term growth. There are also more advanced, more prudent regular monitoring and early warning system for many countries to come. So that's a traditional Brady bonds. Hopefully, can be applied in the new era in the coming days. They will be able to make some new variations for such transaction. One such is to use a guarantee rather than to use loans to post as collateral. You can probably guess that there will be some cost of any kind of credit enhancement. In a traditional loan for collateral, you may have something called a negative carry, because the country will have to pay interest to IMF and World Bank, which is not too low. And then when they post bonds, for example, in U.S. Treasury is probably not going to pay a very high interest income, so that they will end up an interest differential. So that will be the cost of the credit enhancement. Instead of using that, many of the financial institutions on the development side can offer guarantees nowadays. They actually do charge a guarantee fee, but some of the fees can be more cost effective. So the same transaction structure still holds, but without the policy loan, so they can use credit enhancement. Now, some of credit enhancements also bring policy reform packages. Some may not, so it's really up to the developing countries to choose. Now I move to the second major block of topic, which is to use state contingent debt instruments. It's a long name, most sort of twisting, but it's actually quite straightforward. It's basically a linking the debt service stream to a kind of a variable which matches developing countries' ability to pay. Because developing countries, many of them are vulnerable to boom-bust cycles. Because many of them are, primary commodity producing country, they rely the income on few commodities, either be, say, coal, like in the Zambia's case, 70% of Zambia's exports are coal. Or, for example, I'm quite familiar with Mongolia. It's a lot of these are coal and copper or gold. Many of them are on the agricultural side, like cotton. Their countries' likelihood to succeed is mostly depending on how the price behaves. But the price behavior of these commodities are out of their control. Other so-called contingent variables can be, for example, the GDP, stock index, wages, SOE revenues, and so far so forth. And these are fluctuating. And then once, for example, in the case of GDP, when countries are doing well, GDP-wise, presumably the government income will be higher. Presumably the government's capability to servicing their debt is better. So the interest payment can be linked to GDP so that they can better service their debt. In the worst time, GDP is going low, the interest payment automatically going low, so creating a good hedge to the economy. Now, there are proven cases of either using different contingent variables. I would like to argue, I personally, I do prefer commodity-linked bonds because the commodity prices are more independent. They are not subject to reporting errors, redefinitions along the way, and even potentially moral hazards when country like to, creating a preferential situation to themselves. And also it's relatively easy to use a historical commodity price movements as a prediction for the future so that you can price commodity-linked bonds. On the so-called exposed situation, meaning that country is already in a debt crisis, so they are looking for debt restructuring deals. Commodity-linked bonds can be a good instruments. The argument is such, in many war scenario where swapping the old loan with the new loan is getting very difficult. One common way of doing that is debt equity swap. So you basically swapping the debt to ownership holdings. Effectively switch the debt payments schedule from fixed to variable because everyone knows the equity is not stable. Commodity-linked bonds is certainly more stable, more standardized, more transparent, and then the creditors will probably prefer if commodity price available compared to on the equity side. Many of the creditors can also enjoy the natural hedge because they are probably importers of commodities, they're producers of certain things. For example, China importing a lot of copper from Mongolia because China has always experimenting the construction boom. There will be a lot of furnitures and pipes and needed and made of copper. So because of that, if China also buys commodity bonds, they are the producers putting themselves in a good natural hedge situation. There are a lot of studies looking at this theoretical empirical evidences and showing that there are a lot of benefits on both sides of creditors and debtors. In fact, the first case of Brady Bonds, they already used a similar type of structure with the recapture clause, which is commodity linked. So the structure of the commodity linked bonds, after saying so many good things about, is actually quite straightforward. It's the same structure as in the Brady bond case. So basically same blocks, same everything, except the bonds being swapped and being traded is linked in some fashion to commodity prices. Yeah. But the third variation, which many of the researchers are looking at, is with the green finance, which actually doing a lot of goods to the country themselves, to everyone, and to the whole world. There were a lot of cash from developed market looking for investment in the developing countries for green projects or climate change project, because everybody knows these are global goods, global public goods, and everybody needs to act on that. However, developing countries, whether they are in a good shape or bad shape, are struggling to access to these funds. We counted in another research paper, there are certainly hundreds of billions of dollars around looking for investment. Could be more in the coming years. Now, there's kind of a mismatch between the countries needing capital and then the countries offering capital, partly due to the weak project pipelines. You actually do need strong pipelines of green projects. They have the developing country doesn't really necessarily have an infrastructure in order to monitoring and disclosure all the benefits and costs of green finance projects. And also because of heavy indebtedness of the countries, they actually don't have any room for additional borrowing, even for the green finance projects. So some proposals to use the kind of offering solutions for distress debt resolution or incentivize developing countries to work on the climate projects. So we do trying to achieve win-win situation here. There are quite many proposals, but there are a few successful ones already. So one is such it's relatively small in amount, but it's quite innovative. It's in Seychelles Islands. There was a debt conversion program for marine conservation project. The sponsor, basically the facilitator, is the Nature Conservatory, TNC, in short. They raise funds from grant and loans, putting it into basically a special purpose vehicle, like in a trust form, and this special purpose vehicle will buy, basically providing a loan to the Seychelles government, which buy back the outstanding non-performing loans from creditors, and then basically that will exchange the new loan with the old, exchange the old loan with the new loan. And along the way, Seychelles government will be in agreement with the TNC and other partners to a set of policies to create a conducive environment for green finance. And then the new loan will be sold and serviced by Seychelles government, and the recycled, basically repayments from these new loans will be used for disbursement for green projects. So they basically, through this swapping and recycling program of funds, they started a very prudent, strong program for green finance. So hopefully similar deals can happen in the coming years, but you do need strong institutions, both on the developing country side, on the creditor side, and also you do need strong intermediaries to put all deals together. One sort of caution, because I actually do see many researchers saying, "Oh, this is a great idea. Why developing countries can issue green bonds? They can use the green bonds to swap the non-performing debts." Sounds great. Sounds like sounds like a free lunch, but it won't happen because the green bonds will already pass the period of I don't know, funfair of when everybody issuing green bonds. Investors are now very picky. They are looking at what you're using the green bonds for, what are the benefits, what you can bring, specifically to how much contribution you can contribute to, say, the two degree of temperature. So there are many international standards, the green bond principles, the climate bond standard, EU taxonomy, so on, so forth. So the green bonds needs to meet all these standards in order to be qualified, in order to attract investors. Now, developing country may have difficulties of doing so. So if you look at the database of green bonds being issued, so far, I actually the other day I found one issued by institutions among the DSSI countries, the servicing suspecting countries. So there are a lot of work that needs to be done. Assistance will be needed to reform policies and develop capacities. Now, for Chinese creditors, certainly Brady Bonds transactions are possible. You can look at the similar transactional variations of it. The U.S. Treasury bonds to use as a collateral may be challenging, but there are proposals that the Chinese government can issue global bonds, and then the country can to buy it to use as collateral. China certainly needs to participate in the overall rescue packages and collaborate close with the IMF and G20 and other international organizations. In terms of ICDI, the state contingency debt, I do strongly support Chinese institutions to carefully look at the commodity-linked bonds. So that can be a good, one is a good tool to enhance credit reading, so developing countries reduce their credit risk and to make a transaction feasible. On the other hand, it's also be a good risk management tool for China producers and for China investors, because China is a major importer of these primary commodities. And thirdly, to tap into the green fields of the green finance and climate funds world, basically working with specialized organizations to look at the innovations, to look at how to use green funds to buy back debts. So that's all from me. I'm very much looking forward to questions. Thank you. Back to Dr. Wang Yan, please.
Sorry, Dr. Yang, we can't hear you.
Can you hear me?
Yeah, we can
Yes.
hear now.
For the audience, if you have any questions, please click the Q&A box at the end of your Zoom menu and type in your name, your affiliation, and your question, please. Right now, I don't see any questions, but I would like to take this advantage as moderator and raise the first initial question, clarification question, and just to get us started. I would encourage all participants, students, and also NGOs, please type in your question. My clarification is that regarding the Brady Bond approach, in the 1990s, what was the procedures? Who proposed this approach, and was the debtor country? Was it a debtor country proposed or the creditor country proposed? And then who provided government guarantee, and whether the IMF loans, the treasury loans can be used as the collateral. And also, what do you mean by the haircut? And who proposed 30 to 40% of negotiated? Is it negotiable? And who decided the final haircut? Can you hear me?
Yeah, I can hear. Should I answer you now? Or I can quickly go over. Thank you, Dr. Wang, for these questions. Certainly, the devils are in the details. When we look at the transaction, it is a good practice to look at the details on how to make it work. Regarding the who proposed the approach, generally, yes, it's more of an iterative process of everybody's sort of involved, generally from debtor countries, creditor countries first, and then certainly the IMF or World Bank and other people will be approached, and then they will join. The reason I say so is basically the debtor country is coming to a financial stress, and then they wouldn't be able to service the debt. Usually before the due dates of, say, interest payment, for example, the bank loans, for example, they gave you a 6 months payment schedule. And then a few months before, or even half a year before, the banks already know the debtor may have trouble to raise, to have cash to pay. And then they were looking for solutions. Certainly there are many solutions. You can borrow new loans, you can squeeze out some other cash flows and so on and so forth. But once it's coming to a realization, it's difficult. Then IMF maybe come to their mind. Although in the recent years, countries are reluctant to approach IMF because once you do so, there will be a signal to international community or even rating agencies the country is in trouble. and immediately the ratings can go down. And then once it go down, you actually automatically increase the borrowing costs for the countries overall. So in fact, it does have a cost impact. So countries are reluctant. However, whether they're reluctant or not, usually that end up in the situation. The IMF usually are quite alert. They do have regular monitoring, generally from the Article 4 consultation, and they also have their resolutions situated usually in the central bank in the country, so they know what's going on, and then the whole package will be starting. That's a normal situation, but for Brady bonds, it become a bit of a global program, and then certainly IMF would closely coordinate with the U.S. government to use the Brady bonds as one of the solutions. The guarantee side, as I mentioned, is generally the guarantee is actually in the form of collateral. The debtor countries will post guarantee to their new bonds, the Brady bonds. So they need to buy U.S. Treasury bonds, put in the escrow account, and then the money they used to buy is basically from IMF or World Bank loans, and then so that's a classical way of doing credit enhancement by posting guarantees, by posting collaterals. But that collateral is only for the principal of the debt, not all the interest payments. So for interest payment, they usually, what they call this rolling interest payment guarantee. So basically the government will have come up with other cash to put in escrow in the US, in the New York Fed, in a separate account to guarantee next three interest payment basically for 1.5 years. So that's normally what they do. For haircuts, 35 to 40% haircut. It is also a question to me why every country basically end up at the same level. But apparently it's negotiated. Apparently it's supposed to be depending on the analysis of the IMF team to look at how much haircut will be needed to put country back to the sustainable path. But why all the countries are the same, I actually don't know. It probably become a formalistic approach. Yeah. But it is supposed to be negotiable. Certainly on the creditor side, they don't like it. They wish as much as possible not to have haircuts because immediately that would be resulting a loss to the creditor. And also that will trigger some written off rules of the creditor, which could be complicated. So this is why you actually see countries are issuing two kinds of bonds, the par bonds, discount bonds. The par bonds is actually have no haircut. Rather than the subsidized nature coming on the interest rate side. And then the discount is the other way around to meet the creditor's needs. Okay, so back to you.
Questions in our Q&A. I would like to remind
I can't hear. Can you?
Can you put in your questions in the Q&A box? Can you hear me? Now, the first question is related to the SDR, the use of SDR. Can you hear me?
Yeah. You can hear.
Aldo Calari asks, we are hearing about objections to the feasibility of employing SDRs. So his question is regarding how can use SDRs in this debt restructuring, and the question is, can you elaborate how you would use SDRs for the credit enhancement? The second question is from Zhuchun Kwang, Uppsala University. The Brady bond-like solution depends heavily on multilateral discussions among participants. How do you make sure creditors or debtors collaborate efficiently. For example, China has involved heavily with the bilateral debt relief discussion, but not so much on multilateral negotiations. What would be the implications of this? So can you first answer these two questions?
Yes, Dr. Wang, thank you for these insightful questions. The first one regarding the feasibility and employability of SDRs for credit enhancement. My understanding is certainly the new increase of SDR allocation of $650 billion is distributed to all the members of IMF. I understand the mechanism is there's a SDR, some sort of organization within IMF. The countries can join, and then basically the SDR will be allocated to that organization. Everybody has their shares based on their basically the contribution, the share in the IMF. So SDR become their official reserves, and then certainly the country within their own domain of the official reserves, the country has the freedom allocating that reserves for whatever the purposes they are counting. They can use it to certainly purchase, say, some sort of a bonds for collateral. That collateral can be posted for special purposes for them to issue Brady Bonds-like kind of debt. So that's how it goes. But the least developing countries, because they are relatively small in size, and particularly financially, the ICR allocation was not that huge. The estimate is about $25 billion in total for those heavily indebted countries. So there are another thing that people are discussing is these countries can basically borrow among SDR members of IMF additional SDRs, and then basically become their liability. And then suddenly they can, because they borrow, just like IMF loan, they can use it to purchase collaterals to provide a guarantee. So that's how the process goes. Certainly the new borrowed SDRs is in the loan form, so they need to find a way of paying them back. On the second question on the this is very insightful, which is true. The multilateral discussion among participants, it does need sort of bundling of certainly the distressed debts and also bundling of the creditors to make it work. On China's side, China traditionally was on the more like on the bilateral sort of a debt relief process, and also China has its own process and standards. For example, the haircuts for them can be quite difficult, and then China prefer probably debt restructuring more compared to haircuts. However, and then in the new round of debt restructuring, it appears because China is going to be a major player, China become a major creditor to many of the countries. For Brady Bonds to work in a new time period now, China will have to be there. Otherwise, these things probably not going to happen. But I think China is willing to. Collectively, they always have good benefits of being a group. So hopefully the process will start and China will be part of the process. But certainly a lot of work needs to be done. And this particular piece of research actually initiated by Dr. Wang Yan is a very important one. So I hope it is sort of going to the correct path. Back to Dr. Wang, please.
Yeah, just follow on that. Actually, our colleagues, friends in the CAS, the Chinese Academy of Social Science, they have made some draft and proposed to the IMF regarding Brady-bond-like approaches and utilized newly allocated SDRs to be injected into the existing trust fund, etc. That was presented in a workshop that we organized in September 8th and 9th. Now we have the third question. Professor Grant wrote from Boston University. During the 1990s, what was the range of the renegotiated interest rate compared to Mexico's? Mexico's LIBOR plus 100 basis point. As an example, what rates might we expect in the current era?
Okay, thank you, Dr. Wang Yan. For this particular question on the interest, particularly floating one, LIBOR plus, I understand the discounted bond, the haircut was 35%, and then the floating rate is LIBOR plus 13 over 16. I don't know how many basis points, but that seems to be a standard of this ratio. Why is such a ratio of 13 over 16 is a challenge to me. Also, I actually don't know. Presumably, it's negotiated. But if you look at the similar deals with all other countries, they basically follow the same structure, LIBOR plus that. But the reading can be different, which is also interesting. But whenever it's being traded, certainly it be traded at the premium or the discount, so the market will take it appropriately. On the current era, it's also on the technical side is can be challenging because of reference of LIBOR can be challenging now, and also we are in a low interest rate environment. In fact, in a workshop a week ago, there were also this question about how much room Brady bond, particularly on this interest sort of subsidized interest side, how much room we can play. It look like it's not so much, but for the heavily indebted country where the credit rating tends to be certainly way below the investment grade, the premium of their interest is still high for their sovereign bonds. So I guess from that angle, if you issue par bonds with a fixed rate, with a heavily discounted interest rate, you still have a lot of room to play. So basically the reference rate is probably not very important. But yes, these are the technicalities. We actually still need to look at the details. Certainly both sides of creditors and debtors will need to come to agreements.
Yeah. I don't see any new questions, but from last week's workshop regarding that restructuring, one of the takeaways.
Dr. Wang, you do have a question below.
Oh, below, okay. Let me have this. Concalo Pina from ESCP Business School. She asked what maturity do you think the commodity price linked bonds should have? For example, the Mexico Brady bond with value recovered clause and a maturity of 30 years. Would you suggest reproducing these maturities? I asked because the link to the price of oil over 30 years could expose creditors a lot of fluctuation. And you can see the question below. State contingent bond instruments can solve these issues.
This is also a very insightful, good question. Yes, the tenor, the sort of maturity of 30 years can be difficult for commodities. Generally, you do see shorter maturity of commodity-linked bonds for the reasons of such, because it's kind of difficult to predict over the long time. Certainly, commodity-linked bonds has a good advantage of providing hedging instruments for both producers and consumers and also importers for relatively longer term compared to say forward or futures market, which tend to be very short term, one year, and anything beyond is difficult. For this one, based on the say production cycle, inventory cycle, they may be having an optimal for different commodities, an optimal tenure that both sides would benefit from. It may not be for 30 years and maybe say 5 years and 10 years, which will be already a very useful instruments. And I guess when you issue the new bonds, you can always keep it rolling for another 10 years and so forth, so that you reduce this risk associated with the longer term. But the lower part of your second part of the question, whether you created this incentive for producing and so on and so forth. Generally, the bond amount may not be that covering that high percentage of your domestic production. So I don't expect it created such a huge disincentive even on the production side. But even it does, for example, in the small agricultural commodities case, many times because the country doesn't really have too many other choices. I mean, they are heavily dependent on primary commodities. So hedging their commodity risk for the relatively longer term probably bring more benefits than harm. So thank you.
So I don't see any new questions. Can you, Dr. Ying Chen, can you use 2 minutes to summarize, and especially regarding the challenges that we are facing now? How come that Brady-bond-like instruments are not created and not discussed openly, and what are the obstacles?
Thank you, Dr. Wang Yan, and I'd like to thank all the participants and for your participation, and also these questions are very insightful, and you certainly also kind of giving me new insights and new questions that I can look forward to. On the new era of debt restructuring, say 2020, so year beyond, certainly the world has advanced much more from 30 years ago. Everyone learned a lot. There are many different variety of debt restructuring choices and options and tools. So Brady Bond was one of such. Certainly it had a good successful story back in the 1990s. It also contributed to the development of developing countries' sovereign bond market. The reason, I mean, I wouldn't say a reason, but I guess because of many choices, because of practical considerations of different creditors' own interest, so far the Brady Bond initiative was not yet to be so-called the mean voice, but we cannot rule it out because collectively creditors may still find this a good tool. I guess it does have benefits of consistency, collect more of sort of mapping to international standards, transparency, create good incentives for good, good behaviors on the debtor side, on the creditor side. So a lot of the benefits are still there beyond transaction itself. So I'm hoping all the creditors and debtors were looking at it. Challenges will be like questions asked earlier. Now we're a low interest environment. Now we have, say, China there. People may not necessarily know, even China themselves may not necessarily know what are going to be the common practice coming forward. So now is the opportune time to basically educate all the stakeholders, looking at the options, looking at the merits, look at the pros and cons of different approaches, where Brady bonds can be part of it. So thank you, Dr. Wang.
Thank you very much, Dr. Chen Ying, for sharing your new research, and thank you all for attending. Just a bit advertisement. Dr. Chen Ying's paper has been published as the GDP Center's working paper. A link has been provided on the chat box in the chat box below. And a little bit about future events. This research colloquium will be hosted on the third Wednesday of every month at 9 a.m. And the following topics are, on Wednesday, October 20th, I will present my new research on Africa and China, structural change and economic transformation. On Wednesday, November 17th, Yang-Siyu Lu, a research fellow at GDP Center, will present her new research on environmental risks and power plant suspension. On Wednesday, December 15th, Austin Strange, assistant professor from the University of Hong Kong, will join us to discuss his new book, Ranking on Beijing, the aims and the impacts of China's overseas development program. If you have attended this seminar, registered to this webinar, you are automatically registered for the full semester. So no new need to register again. You can also subscribe to our newsletter to receive update for our Global China Initiative in both English and Chinese. Thank you all for coming, and see you next time.
Thank you.